Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video we're going to look into 5 companies that are high growth, high risk companies. We haven't done a video like this for a while, and the reason has been quite simple because everything else has been going to the moon, and these companies, some of them have done an absolutely amazing job. Now the reason why we should all be looking at some of those kind of companies is because of the growth side of it. Whether you are, you can be a dividend investor, but at the same time have some of, the high growth companies in your portfolio. There's nothing wrong with that, as long as you know what percentage of your portfolio that should be high growth companies. Surely I did it when I first started. I used to own a few companies, some of which actually is on this list today, and I do own some of the companies on this list today as well. So I'm going to share with you these 5 companies, but just bear in mind these are companies that you do not want to be, your entire portfolio just to be these companies, because they are very, very volatile stocks. And I genuinely mean, and you'll see exactly what I'm talking about when we look at some of these returns for these companies and how actually they fluctuate in terms of prices. So it's not for faint-hearted, and some of these companies have just become profitable. So you really need to be careful. What you see here right now is in my portfolio. I've done a portfolio analysis very recently. So if you want to look at that, go and watch it. There's about 26 different companies. All of these companies pay dividends. I've sold my ETFs. I don't own any more ETFs. And I'm not just bragging about that. It's just the fact that I just want to share with the community that I am basically from now on, I will not be owning any ETFs, maybe for at least whatever years coming. I'm just going to sit on the side and just carry on doing what I'm doing and build my own ETFs. This is exactly what I'm trying to do so I can manage it. I do have a lot of time in my hands right now, alhamdulillah. I said a lot of time to manage this portfolio. But in a few years down the line, I might not be able to. And then that's probably the day where I will be maybe switching more to ETFs. But I think there will not be, I don't think there will be any time where I don't own any ETFs, any individual stocks, because I genuinely do like these companies and I like doing the analysis and all of these things that I share with you guys. Now, if you haven't liked the video already, please do so, because it genuinely helps the channel. I decided to share my journey with you guys, in basically about 4 or 5 years ago, and I'm still doing every single day. If you watch every single video for the last 4 years, you will see I've shared this portfolio when it was, I think it was about £23,000. Well, since then it's gone about £100,000, and basically I've shared every single time the mistakes that I made, things that I've done. So if you like that transparent side of things and you want to join this journey of basically trying to build a Sharia compliant investing portfolio, then of course you join us in the Patreon account, where you get access to a lot of things, including the family portfolio. The family portfolio is not huge. It's over, I think it's about £10,000 or so in terms of value, and there's quite a few companies that I talked about recently. So if you want to see what's in the family portfolio, I do make some changes. I made some changes last month. I'm going to make some changes this month, so I will share basically all the buys and sells, and you get access to the family. But the most important thing for me, and I genuinely mean this, is the Discord. Discord has a lot of wonderful brothers who genuinely share good practices on a daily basis, and I'm talking about everything from, and recently we've actually added to crypto as well. I don't basically talk about crypto. I don't own any crypto, but some of the brothers do, and they talk about that as well. So yeah, if you're enjoying this type of content, you want to be part of the community, join us inshallah and just learn something. It's not going to cost you more than £5 for the first month. Try it out, see how it goes. If you like it, stick around, and definitely helps the channel inshallah. Now let's talk about these 5 companies. So things that we're looking for is the market cap, the moat of the company, the 5-year average when it comes to the 5-year revenue compound annual growth rate, same for EPS, same for profit margin, return on equity, return on invested capital. So we want to see where the company has been, where the growth-wise side of things in the last 5 years. It doesn't tell us what's going to happen in the future, but gives us at least an idea. Then we got the profit margin, return on equity, return on invested capital, to kind of help us understand how profitable are these businesses, how good are the management in terms of managing the capital they gain from us, and so on, and reinvesting in the business to generate more profits for us. We want to see free cash flow. Free cash flow is very important for these companies, because high growth companies, when the interest rates are very high, they can't borrow money from the bank because of high interest. If they have free cash flow, they can use that to actually build, because remember, these high growth companies are still on their growth side of things. So they need to reinvest a lot of the capital, and if they don't have that, then they will have to go to the bank. So if you don't want the companies that are borrowing a lot of money from the bank, so on. And free cash flow margin also will help us as well to understand how that free cash flow has been over the last whatever years. EPS growth for the next next year, and then revenue growth for the next year as well. So where is the company going to be? And this, I highlighted this because some of the companies are doing absolutely expected to do really well over the next whatever years. That's why I call them high growth. We'll look at the Morningstar valuations, how many stars this company has, and the fair value price, which is basically where the stock price should be to be fair valued, basically. And the first company we're going to look at today is CrowdStrike. CrowdStrike is one of the companies I've had in my portfolio long time ago. I wish I've never sold it, because right now it's over 400. I think I sold it over 100 something at the time. Made a little bit of profit, alhamdulillah, but sold it a very long time ago. CrowdStrike is a cybersecurity company that specializes in cloud native and endpoint security, threat intelligence, and the cybersecurity responses. Basically, they have a flagship product called CrowdStrike Falcon, which is basically AI-driven endpoint detection and response platform that helps organizations detect, prevent, and respond to cyber threats in real time, which is absolutely amazing. So basically, it's sort of a cloud-based cybersecurity kind of company. And right now, as you can see here, the last 5 years, the revenue grew about 56%. EPS is flat because the company has been not generating, of course, basically has been a negative, basically they went up EPS negative basically over the last whatever years. So they're starting to become now positive. So the last 5 years is still zero, and the profit margin, return equity, return invested capital almost non-existent, which is absolutely fine, by the way, because if the company it's not profitable yet, they're not positive EPS, they're not going to be profitable. So hopefully in the next 5 to 10 years, I'm sure this company will have a amazing double digits minimum profit margins, return equity, and so on. Free cash flow, they have over $1 billion, which is really good. Free cash flow margin of 98% because they became free cash flow positive very recently. EPS growth expected to be about 17% next year, which is normal for this company. And revenue growth is expected to be about 21%, which is really good. So in terms of growth side of it, really good. But right now it seems very expensive. $300 per share is where they think Morningstar basically says where it should be. And to be honest, I think that's true. When it comes to this stock, is very expensive. It's gone up so much over the last year. I think for 1 year, it's up about 31%. For year to date, it's about 24%. But when you look at the last 4 years, 552. So if you had it, I think when I was buying, it was about 2020, sorry, not 2000, 2020 or 2021, I think. If I held it for those years, basically, I'll probably be about around 400% by now. But overall, alhamdulillah, I don't want to regret about anything. It has a forward PE of 114 in comparison to, because now it has a positive EPS. I'm sure this is the first time this company has an actual forward PE, more or less. So it is a great company. Let's have a look at in terms of, in fact, let me look at the financials first before we do anything else. That's very important. And as you can see here, from in the millions to right now, $3.7 billion from the trailing 12 months in terms of total revenue. The cost of that is very low. $2.8 billion basically is what they have as a gross profit, and that's why they just have a gross profit margins, whatever. They spend a lot of money basically based on selling, general administration side of things, the research and development, other operating expenses, and so on. And then overall, you just need to look at the net income. So you can see it has been negative all these years, but last 2 years, basically 2024 and the trailing 12 months, that's when it became a positive, and that's when they started to become have a free cash flow and so on. And as you can see, same things goes for in terms of EPS as well, has been negative all the way to 2023. Now you can see it's becoming a positive. So this is really good company. I mean, overall, it is heading the right direction. And if we look at the Wall Street expectations, we got 26 strong buys, 13 buys, 10 holds, 1 sell, and 1 strong sell. And when you look at this, basically they're expecting the downside of about 10%. So $383 per share. Like I said, it seems a very expensive company right now. The next one that we're looking at today is AMD. AMD is a company that I've been talking about quite some time. In my opinion, right now, it is actually quite cheap. 4 stars, $160 per share, 174 billion market cap. So it's still great company, huge company if you think about it. Last 5 years, revenue grew about 31%. EPS grew about 15%. Profit margin, return on invested capital, decent, $2.4 billion and of free cash flow. 54% free cash flow margin. Expected earnings to grow about 43%, revenue to grow about 24%. And like I said, 4 stars right now, and $160 per share is where they think the price should be. And we talked about this company a lot. And we know that when it comes to GPUs, they've probably been one of the best companies out there of the last whatever years. Apart now, Nvidia's coming in. Basically, it's been in the market as well, but because of the AI situation, Nvidia has taken over. This company is now way better than Intel. Intel used to be the market leader, so they've got really great products in terms of that companies that they work with, like Xboxes and so on for Microsoft. And when it comes to gaming GPUs, CPUs, all of these things, it's probably one of the best out there. This company, I do own it in my family portfolio. I've added to it recently. I bought it and I added to it recently as well. So yeah, I'm gonna hold on to this one for a very, very long time. I'm not worried about what the market basically says right now. It's still cheap. I will be buying more, inshallah. And looking at it for the 1 year, about 35% down. So when the S&P 500 and all the other semis have been going up, this company has done absolutely nothing. A year to date is actually down about 7%. Last 6 months about 18%. So when you look at that, it's just basically it's crazy. Let's look at the financials very quickly. So you can see from $3.9 billion to now $25.7 billion of basic revenue, which is ridiculous. $12 billion of cost of that revenue, $13 billion gross profit. So research and development, they're spending a lot of money on that, which is rightly so. I'm happy to see that. And the net income of $1.6 billion. EPS is basically it's been in the negative, and then basically became a positive in 20 because of COVID, and everyone was buying these laptops and whatever technologies. As basically these companies have done really well during that time, a lot of the technology companies, and then it kind of came back to the basically what it was before then. Okay, now looking at the earnings ratings, from Wall Street, you will notice 27 strong buys, 7 buys, 15 holds, and 1 strong sell. And overall, as you can see, it's about 34% up, so basically upside from now on. $149 per share is where they think the price should be. Another great company, I'll be honest with you. This is one I would like to hold on to for a very long time. And as you can see, the growth-wise, absolutely amazing. And then look at this when it comes to revenue, both revenue and EPS. In fact, before we move on, let me show you CrowdStrike as well. Okay, more or less the basically amazing growth expected over the next whatever years. So both companies are really good, the ones that we looked at so far. And I'm not exaggerating saying go away and buy it, but you need to do your research. Another one that I used to own back in the days in 2020, I think, and I made a little bit of money and we got out of it. That's Cloudflare, another company that is another technology company. Basically, they are web performance and cybersecurity company that provides content delivery network. Basically, it protects DDoS protections and internet security services to websites. And some more websites that I use when I'm making a payment and things like that. This is actually the company, or even logging into certain systems. Basically, they use this company to actually protect their content and so on. 57 billion market cap, narrow mode, right, $171 per share. Last 5 years revenue grow about 43%. EPS basically has been negative, and I think it's still negative. Profit margin, return on invested capital, it's not there yet. Basically free cash flow just a little bit, 30% when it comes to the free cash flow margin. They're expecting the earnings to grow about 9% in EPS, revenue to grow about 26%. So it's a little bit expensive right now. They're expecting the price to be $87 per share, and as you can see right now it's $171 per share. And as you can see here, 62% basically growth, basically up at 62% over the 1 year. A year to date, almost a 6%. Last 6 months, about 124%, which is absolutely ridiculous. And now if we look at the financials for this company, what you will notice is we were in the millions, now $1.6 billion. Look at the cost of that revenue, very, very small, but $1.2 billion in terms of gross profit. Of course, they're going to spend a lot of money on research and development. Net income is still negative, and EPS, as you can see here, still in the negative. So you're gonna have to take a bit of a risk if you were investing in this. This is why I said these are high risk, high reward. And if you were basically to own the company by the end of this year, you're expecting about 6% or basically whatever. But in 2026 December, they're expecting the earnings to be about 30% up year over year. And look at this, 28 analysts are looking at this. And December 2027, they're expecting almost 50%, but there's only 6 people looking at that. That's that's EPS. And revenue side of it, again, 25%, 27%, 29%. Even if you just focus on the first 3, that's absolutely massive growth for this company. Now we got 2 more to go. The next one is Arm Holdings. This is a brand new company, when I think public very recently. It was basically, I think it's just still a UK based company. Is basically UK based, but they decided not to basically go public in the UK. 171 billion market cap, wide mode, $159 per share. This is non-existent because they have not been in existence for the last 5 years. Profit margin, return on equity, return on investor capital to the company has been around. It was private company all these years, and then I think it went public, and then it went private again because another company bought it, and then it became public again. I can't remember the story, but they are profitable because they've been selling actual great products over the whatever years. The free cash flow is a little bit disappointing, but when it comes to EPS growth, expected to be about 27%, 24% when it comes to revenue. Right now, very expensive, $66 per share. This is where they think the price should be. 150, let's call it $160 is basically where it is right now. And if we look at it for the 1 year, it's up about 7%. A year to date is about almost 30%, and the last 6 months about 36%. So it's done really well. If we look at the financials very quickly, you can see it hasn't been around for quite some time. So $2 billion, $2.7 billion, $2.6, $3 billion, $3.6 billion. And then look at that cost of that revenue, very small. $3.5 billion of that 3.6 is basically gross profit. So gross profit wise, basically that's why we're looking at here. When we look at the gross profit, it's about 21%, 22%, whatever it is. Okay, they're going to spend a lot of money, of course, research and development and all of these things. Right now, they're positive when it comes to net income. EPS growth is basically heading in the right direction. This one here, that's the one that we're after. Okay, so it's a great company overall, and it seems it's heading the right direction in terms of revenue and things like that. And when it comes to EPS estimates for the next basically whatever years, as you can see, the first 3 here, there's a lot of analysts that are interested in this company. 26%, 26%, 29%, almost 30% in 2027. And then when you look at the revenue side of it, is also doing absolutely amazing job, which is really good to see. Now, if we look at the ratings from Wall Street, okay, and as Seeking Alpha analysts are saying it's a sell, Quant is saying it's a hold, Wall Street. So you've got combination of everything. 17, we got 17 strong buys, 6 buys, 13 holds, 1 sell, and 3 strong sells. And right now it's flat, basically 158 is what they expect. 150, let's call it 160 is where it is right now. And final company we're going to talk about today is Team or Atlassian, another company that has been around for a few years. And I remember when COVID was happening, this is probably one of the companies that was going to the moon every single day, and it was basically, they were similar to these big boys here. And the company is a software company that develops tools and collaboration, project management, software development. It's best known for products like Jira and Confluence, I think it's called, which helps team plan, for example, track and manage work efficiency and so on. So it's again another technology company. 82 billion market cap, narrow moat right now. $317 per share. The 5-year growth rate for the revenue is 28%. Negative, it had negative EPS over the last whatever years, so that's why it's 0. Profit margin and return equity, return investor capital is still in the negative. $1.3 billion of free cash flow, which is really good, and free cash flow margin of 22%. They're expecting the earnings to grow about 22%, revenue to grow about 20%. Right now it seems very expensive, so $220 per share is where they think the price should be. And right now, as you can see, is $317 per share. Now if we go here and type team, what we want to see is first we will see where the company has been over the last whatever years. For the 1 year, 47%, a year to date 30%, and last 6 months 126%, which is absolutely crazy. And look at this forward PE of 91. Look at Quant is saying strong buy, Wall Street saying it's a buy, Seeking Alpha is saying it's a buy. So that's one of the reasons we decided to look at today this company. And here is the total revenue, so in the millions to right now $4.7 billion. Again, look at the cost of that revenue. This is why I really like software companies, because there's not too much overheads. $3.9 billion of that 4.7 is the gross profit. Now, of course, they're going to spend a lot of money in research and development. And right now, when we look at the net income, it's still in the negative, which is a little bit crazy. And then when you look at the EPS, it's still basically in the negative. So again, another company that is still under development and still growing the business side of things. And if we look at the EPS, basically expectations moving forward, okay, you can see 20%, 22%, 21%, and so on. And then same, more or less similar basically numbers when it comes to the revenue side of it. So growth side of it, everything basically seems great. So like I've said to you guys, these are high risk, high reward companies. You get in this sort of, and remember, when earnings grow and revenue grows, the stock goes up with it. Because remember, whenever the companies report amazing numbers, that's when basically people start buying the stock and so on. So that's the 5 companies I wanted to share with you guys today. Sharia compliance side of it, just be mindful of these two here. They're on that borderline, that 59%, and these two, CrowdStrike, whatever, we might want to look into why that is. So Cloudflare and CrowdStrike basically closer to that. But the rest of them, in terms of debt-wise and things like that, these companies are absolutely amazing when it comes to that sort of thing. So if you're looking for high growth companies to add to your portfolio, maybe you can put this on your watch list, do a little bit more research. This is the only one that's cheaper, and that's the only one I currently own. I would love to own CrowdStrike again, but it seems very expensive. So if it comes back down in the now, maybe next whatever months, I will definitely love to add this to the family portfolio, inshallah, and let you guys know. Anyway, that's the companies that I wanted to share with you guys. I hope you enjoyed this content. Have a wonderful day. Assalamu Alaikum.